Welcome back to Intermediate Accounting and our second video on Chapter 18, Revenue Recognition. Just to summarize what we covered in the last video, there are 5 steps to the Revenue Recognition accounting standard. Identify the contract with the customers, identify the separate performance obligations in the contract, determine the transaction price, allocate the transaction price to the separate performance obligations, and recognize revenue when each performance obligation is satisfied. Just to review very briefly, steps 1 and 2. Step 1 is identify the contract with the customers. Remember that the contract can be written, oral, or implied. Step 2, identifying the separate performance obligations. When we break down the contract, we're trying to determine what are the distinct performance obligations. And a product or service is distinct when the customer is able to benefit from the good or service on its own or together with readily available resources. We're trying to figure out whether the overall goal of the contract is to provide one bundle of goods or separate individual goods and services. This video is going to cover steps 3, 4, and 5. Let's start with step 3, determining the transaction price. The transaction price is the amount of consideration a company expects to receive from the customer. Oftentimes, it's pretty straightforward. It's written directly into the contract, but some other factors may require us to put in a little more effort to solve for what is that consideration. Companies have to consider variable consideration, time value of money, non-cash consideration, and consideration paid or payable to the customer. So let's take out our template slides and a pen or pencil, and let's get started with some notes. When we don't know for sure or with certainty what the amount of consideration is in the contract, because that amount depends on some future event or outcome, we call that variable consideration. That variable consideration might be due to a discount that may or may not be taken by the customer, rebates that may or may not be taken, credits that might be given, performance bonuses, or royalties. Companies use one of 2 methods to determine the contract amount when it's providing its performance obligation, or even when it's recording the cash up front, perhaps, and recording the amount of unearned revenue. The company estimates the amount of revenue using either the expected value method or the most likely amount method. Let's take a look at each one of these. Let's start by looking at the expected value method. Expected value method is the probability weighted amount. So it's the statistical meaning of expected value. Probability weighted amount in a range of possible consideration amounts, or most likely cash amounts. It's typically used when there are multiple possible outcomes. So let's say we offer our customer a 5% discount if they pay within 30 days. We offer them a 3% discount if they pay within 60 days, and we offer them a 1% discount if they pay within 90 days. And past 90 days, they have to pay the full contract amount. Well, those are multiple possible outcomes by which we can say what is the likelihood that the customers are going to pay within the 30, 60, or 90 days, or perhaps not take any of the discount periods and just pay the full 100%. We can estimate the transaction price using the expected value method or using the most likely amount. The most likely amount is the single most likely amount. In a range of possible consideration outcomes. And this is typically used if the contract only has 2 possible outcomes. Either the customer is going to take advantage of the discount, or they are not going to take advantage of the discount. In that situation, what the company might do is just use that most likely amount. Let's take a look at an example. Peabody Construction Company enters into a contract with a customer to build a warehouse for $100,000 with a performance bonus of $50,000 that will be paid based on the timing of completion. So the company is trying to encourage or incentivize early completion of this. The amount of the performance bonus decreases by 10% per week for every week beyond the agreed upon completion date. The contract requirements are similar to other contracts. that the company has been under, and management believes that such experience is predictive for this contract. Management estimates that there is a 60% probability that the contract will be completed by the agreed upon completion date, in which case it would have a full $50,000 performance bonus. There's a 30% probability that it'll be completed 1 week late, so 90% of the 50,000, and a 10% probability that it'll be completed 2 weeks late. Therefore, the company would get 80% of the 50,000 performance bonus. Let's take a look at how much revenue the company would record, or the amount of the contract, if the company is using a probability weighted method. So we say there is a 60% chance of the full contract amount, 150,000. That is of course, this is the 100,000 plus bonus. But what is the amount of the bonus? If there's a 60% chance that the company is going to have the entire 100% of the bonus, there's a 60% chance that the total consideration is going to be 150,000. So we multiply 150,000 times 60% and get one portion of our expected amount is 90,000. We add to that there's a 30% chance that it will be completed, the contract will be completed 1 week late. And in which case we would have the 100,000 plus a bonus that is $50,000 times 90%. So that bonus would be reduced by 10% if it was 1 week late. So that would work out to be 145,000. Again, that 90% is we would reduce the bonus by 10% if it was 1 week late. So we take 30%, multiply it by 145,000 to get 43,500. And we add to that the third likely expected possible outcome. The company says there's a 10% chance that they will complete this contract 2 weeks late. So the total amount of consideration would be the 100,000 plus 50,000. If we were reducing the bonus by 10% for 2 weeks, we were going to take 80% of the bonus amount of 50,000. 100,000 plus the 40,000 would be 10% chance of having 140,000. Multiply 140,000 times 10%, we get 14,000. And we add all of this up, and we get an expected contract amount of 147,500. So that's now, if, on the other hand, management believes that there's a 60% chance that the company will meet the deadline and receive the full $50,000 bonus, and a 40% chance that it will not, then the company is more likely to value this contract using the most likely amount method. So what would the total transaction price be? Well, we would typically say that if we're using the most likely outcome, then it would be the full 150,000. This is the outcome with the highest likelihood. And in this example, that's 60%. Now, we're only allocating variable consideration if it's reasonably assured that the company will be entitled to the amount. If we're quite uncertain that we may not get the bonus, then we are not going to include that in the contract amount. And we only recognize variable consideration if we have similar contracts and we're able to estimate the cumulative amount of revenue. And based on experience, we don't expect anything significantly different, no significant future reversals of revenue, nothing's going to change later on. If these criteria are not met, then revenue recognition is constrained, meaning we would hold off until we know the certainty or we know the reversal of revenue. We err on the side of caution. We don't want to recognize revenue too soon. The next thing we're going to look at is determining the transaction price is the time value of money. When contracts, a sales transaction, involve a significant financing component, what happens? Interest is accrued on the consideration to be paid over time. What we do is we determine the fair value of the goods or services that are providing, just the same way we would in any other situation. We discount to the present value of What is that goods or service worth to us today based on our likely interest rate, some imputed interest rate. And the company is going to report the difference as interest revenue. Now, we only recognize the time value of money on contracts that typically are longer than 1 year. If there is a time value component, but it is a 1-year contract, oftentimes companies will just ignore that time value of money component. Let's take a look at an example. On July 1st, 2020, SEK Company sold goods to Grant Company for $900,000 in exchange for a 4-year, zero interest-bearing note with a face amount of $1,416,163. The goods have an inventory cost on the seller's books of $590,000. How much revenue should the company record on July 1st? So as you look at this information, what are the possible options of how much revenue? Is it either 900,000 or the total amount of this zero interest-bearing note receivable of 1.4 million? Well, what's the difference between these two terms, 900,000 and the 1.416 million? That difference is due to the time value of money. So the goods have a fair value. If a customer is paying cash today, July 1st, the company, SEK Company, would sell those goods for 900,000. Why is the contract for more than that? This 1.416, why is that the amount of consideration? Because the customer is going to pay over 4 years. And even though this is a zero interest bearing note, we know that the interest is actually embedded in this difference between the 900,000 and the 1.416 million that the customer is eventually going to pay. So how much revenue should the company record on July 1st? They should record revenue equal to the fair value of the goods or service. So what does this entry look like? The company is going to debit notes receivable. The cash is going to be received by the company in 4 years from July 1st, 2020. Notes receivable in the face value of that note, the zero interest bearing note, 1.416 million. The company records sales revenue equal to the fair value, or we can call this the present value of the goods or service that was provided. And then the difference is going to be recorded when it's a zero interest bearing note. We record that interest to be earned in the future. We call that a discount on notes receivable. And that difference is 516,163. Now this is inventory that we're selling, and we know what the cost of the goods sold is. The cost of the goods sold is 590,000. So we're also going to debit the expense, cost of goods sold, and decrease SEK, or the seller's, inventory. How much revenue would the company report related to the transaction on December 31st, 2020? Well, what is that revenue going to relate to? This is going to relate to earning a portion of this 516,163. We recorded this in the discount on notes receivable, a contra asset account. Over time, we're going to reduce that contra asset, and we're going to start recognizing interest revenue as an adjusting entry at year end. Although it doesn't say it here, it should assume that the interest rate, the imputed rate, SEK's interest rate or implicit interest rate is 12%. So let's record the amount of the interest at December 31st, 2020. We want to reduce that contra asset, discount on notes receivable. When we reduce a contra asset, we are increasing assets. And we are going to record an increase in interest revenue. And what is the amount of this? We are going to take the face value, or the net carrying value of the note, the present value of that good or service, of the beginning present value of 900,000, multiply that by the interest rate times the portion of the year. So this was from July 1st through December 31st. So 6 out of 12 months, and that works out to be 54,000. So assets increase by 54,000, and revenue, and therefore net income, increase by 54,000. Another factor in determining the transaction price is non-cash consideration. So what if the contract is set up where the seller is going to receive something other than cash? Could be either a contribution, donation, a gift, or contributions of goods and services from the customers. What we do, the rule here, we just have to remember, companies recognize revenue on the basis of the fair value of what is received. We don't need to look at an example of that. We just need to remember, record based on the fair value of what the company receives. Another component of determining the transaction price, consideration paid or payable to customers. We're talking about if we as a seller allow a discount, volume rebates, coupons, free products, or services. These items are going to reduce the amount of revenue and consideration received, in other words, accounts receivable or cash, and also reduce the amount of revenue to be recognized. Let's take a look at an example. Samsung Company offers its customers a 3% volume discount if they purchase at least $2 million of its product during the calendar year. On March 31st, 2020, Samsung has made sales of $700,000 to Arctic Company. In the previous 2 years, Samsung sold over $3 million to Arctic in the period April 1st through December 31st. The question is, how much revenue should Samsung recognize for the first 3 months of 2020? So the issue here is we don't know. The customer can take advantage of this discount if the customer ends up buying at least $2 million. By March 31st, sales have only been $700,000. So we don't know whether Arctic is eventually going to buy enough to be able to take advantage of that 3% discount. So what we do is we say, what do we expect to happen? Do we expect Arctic to be our customer to be in the situation where they could take advantage of the discount? Well, we see based on our historic experience with this customer, we typically sell well over the $2 million necessary to qualify for this discount. Therefore, we assume that the company, our customer, is going to take advantage of this discount. We, Samsung, are going to record how much revenue on this contract. Because we assume that they are going to take advantage of the discount, let's reduce the contract amount by the discount expected to be taken. So we're going to reduce revenue by $21,000. Or we can look at this and say, what should the contract be for? 1 minus 3%, 97% of the 700,000, 679,000 is the revenue that we should record. And what would that entry look like? We would debit accounts receivable, they haven't paid us yet, and credit sales revenue. Assuming the company meets the discount threshold, we said then, as we expect that they will, we're going to record the receipt of cash for the 679,000. We decrease accounts receivable because the customer has just paid us. And let's look at the other possibilities. So it's either going to be option 1 or option 2 in the future. The customer fails to meet the discount thresholds. Well, we've already recorded revenues at 679. What if they fail to take it? The customer fails to take advantage of this discount? Well, we're going to get cash in the full contract amount, 700,000. We take off the accounts receivable that we had recorded previously of 679,000. We need to take that off the books. And where do we record the remaining 21,000 of this discount that wasn't taken by our customer? This goes into an account called sales discounts forfeited. And this account that I don't believe we've ever seen before is reported in the income statement in the section titled Other Revenues and Gains. In the Other Revenues and Gains, or in the non-operating section of the income statement. Let's move on now to step number 4, allocating the transaction price to separate performance obligations. Now, if there's only one performance obligation, let's say Best Buy is selling an iPhone for $800. It's very clear what that transaction price is that should be recorded, the $800 at the time that the sale is given to the phone is given to the customer. But what if Best Buy sells a phone, says that its phone is free to the customer, and bundles that sale of that phone together with a 2-year service agreement? And the price charged to the customer for both the phone and the service agreement for 2 years differs from what the price would be for the phone plus the set price of the 2-year service contract. Then how do we determine how much revenue should be recognized at the time that the phone is given to the customer when there's also the component of, let's say, the 2-year phone contract? Here's our accounting rule that we need to determine the transaction price by. It's going to be based on the various performance obligations relative fair values. So in my example, what is the fair value of that phone on a standalone basis? What is the fair value of that 2-year service contract? Let's look at each one as a proportion of the total fair value of that contract. The best measure of fair value is what the company could sell the good or service for on a standalone basis. Just as I mentioned, looking at that sale of a phone on a standalone basis and the price of the service contract for 2 years on a standalone basis. But what if the performance obligations theoretically could be separated, but haven't been, so we don't know exactly what fair values are on a standalone basis? So that's what we're saying in this third bullet point here. If fair value on a standalone basis is not available, companies should use their best estimate of what the good or service might sell for as a standalone unit. So how do we come up with this best estimate? If those fair values on a standalone basis are not available, we come up with our best estimate on the following slide. The first best estimate, if we don't have fair values on a standalone basis, is to use what's called the adjusted market assessment approach. We look around and say, are our competitors selling this phone and contract and 2-year service contract together? Maybe we haven't done it before, so we don't know exactly what the separate components are their fair values. But if we can see what our competitors are doing and gather a market price, then that would be a good estimate. We may need to adjust because perhaps our markups, our gross profits are higher than our customers, so we might need to use an adjustment on that. If there are not enough competitors for us to estimate the market price or the going rate for the separate performance obligations, then the next best estimate is to use an expected cost plus margin approach. We say, what do we think it cost us to provide these goods and services? Add up what our typical margin or markup is on that, and that's what we would estimate as the fair value of our separate performance obligations. And if neither the fair values on a standalone basis nor items 1 or 2 are available, then lastly, this is the last thing that we would do is use the residual approach. Well, let's say we know the standalone fair value of the phone, but we don't know the contract. Take the value of the whole contract of phone plus the 2-year service contract together, subtract out the fair value of what we do know the phone, and then just assume the difference, the residual, is the amount that we're going to allocate to that service contract. Let's take a look at an example. Handler Company is an established manufacturer of equipment used in the construction industry. Handler's products range from small to large individual pieces of automated machinery to complex systems containing numerous components. Unit selling prices range from $600,000 to $4 million and are quoted inclusive of installation and training. So as you see, equipment inclusive of installation and training, we're starting to think, are these 3 separate, distinct performance obligations within one contract? The installation process does not involve changes to the feature of the equipment and does not require proprietary information about the equipment in order for the installed equipment to perform to specifications. So what this last sentence here is leading us to believe is that another service could perhaps provide the installation. Handler has the following arrangement or specific contract with Kai Company. Kai purchases equipment from Handler for a price of $2 million. The company chooses Handler to do the installation. Handler charges the same price for the equipment regardless of whether it does the installation or not. The installation service in the arrangement is estimated to have a standalone selling price of $20,000. So what we're saying is that the contract price, the total amount of the equipment with the installation is $2 million. But if the installation had been sold on its own, the company would charge $20,000. The standalone selling price, now we have to get to the training sessions. The standalone selling price of the training sessions is $50,000. Other companies can also perform these training services. Kai, the customer, is obligated to pay Handler the $2 million, the sales price, contract price, upon delivery and installation of the equipment. Handler delivers the equipment on September 1st, 2020, and completes the installation of the equipment on November 1st, 2020. That's when the full transfer of the equipment and control of the equipment is given to the customer. Training related to the equipment starts once the installation is completed and lasts for 1 year. The equipment has a useful life of 10 years. So what's the issue here? How much revenue is going to be recognized on September 1st when that equipment is delivered? How much revenue is going to be recorded upon the installation of the equipment on November 1st? And how is the revenue related to the training going to be recorded, considering that it's going to cover a 1-year period? So we have 3 separate performance obligations. Each one is going to determine how and when revenue is going to be recognized. Let's start off with what are the performance obligations for purposes of accounting for the sale and the equipment. So the company's primary objective is selling the equipment. The other services, the installation and the training, can be performed by other parties. So as a result, we have 3 performance obligations. The equipment is the primary, the installation, and the training. Each of these items has a standalone selling price and is not interdependent in the contract. If there is more than one performance obligation, and we just saw that there is more than one, there are 3, how should the payment of $2 million or the receipt by Handler Company be allocated to the various components? Well, we need to allocate $2 million. What's our rule? On the basis of relative fair values of the standalone selling prices. So we see, what is the standalone selling prices? We have the equipment with a standalone selling price of $2 million. So this is like the company offered the installation and the training for free in the contract. The installation has a standalone selling price of $20,000 and the training has a standalone selling price of $50,000. So this gives us a total fair value for the entire contract of $2,070,000. So we say, how much of the total fair value does the equipment represent? And then let's multiply that amount, that proportion here, by the contract value of $2 million. The installation as a proportion of total fair value, and then multiply that by the full contract amount. Same thing for the training. And we get relative fair value on the equipment of $1,932,367, relative fair value on the installation of $19,324, and relative fair value on the training of $48,309. Of course, if we add these up, we would have the total contract price of $2 million. Why do we need to do this? Because when the company delivers the equipment, the company can then recognize the 1.932367 revenue related to delivering the equipment. When it provides the installation, it can record the 19,324 of revenue, and then the training, the 48,309, will be recorded as revenue over the 1 year, over the 12-month period. Let's record those journal entries here. On November 1st, we're providing the equipment and we're receiving the cash from the customer, so we get $2 million cash. We have sales revenue for the equipment that we're delivering on November 1st of 1,932,367. We provide the installation that day, so we have service revenue 19,324. And what about the difference? What about for the amount of the training? Well, we're receiving the cash related to the training, but we haven't provided the training yet. So what account do we call that when we're receiving cash in advance of a service that we have to provide to our customers in the future? That would be unearned service revenue. For the amount of the training, 48,309. And we're also told that the cost of the equipment is 1.5 million. So at the time that we're recording the sales revenue for the equipment, we're also going to record the expense associated with the sale. So we debit cost of goods sold for the cost of the equipment, which we're told is 1.5 million, and we remove that from handler's inventory account. Now it's year end, December 31st, and we need to record 2 months worth of training. We were told that the training services were going to be provided evenly across the 12-month period. We set up the equipment with the installation on November 1st. It's now December 31st. So we take the training amount, 48,309, as you see here, divided by 12 months, or we can look at this as multiply this by the 2 out of the 12 months that have passed, where the 2 months are November 1st through December 31st. And we're using 12 months as the denominator because it's a 1-year contract, 1-year training contract. So that works out to be $4,026 per month that the company, that handler is going to record as revenue for providing the training services. So the adjusting entry at the end of the year is going to be a debit to decrease in earned service revenue. It's going to give me our per month amount. And 2 months have passed. Sorry, this is going to give us our total amount of 8,052 because I have my 2 months here. So unearned service revenue, 8,052, and we see divided by 12, we get 4,026. We multiply that by the 2 months, we get the 8,052. We are debiting to reduce the liability unearned service revenue, and we're crediting to record the fact that we've are recognizing the service revenue. Next, what is the necessary entry the following year related to this contract? Well, it's year end, so if the company hasn't done anything already, what happens? They need to record the additional 10 months remaining on that training schedule, so the training contract. So the 12-month training contract, 2 months ended up in the fiscal year 2020, and the remaining 10 months end up being recorded in the fiscal year 2021. So we have another entry for debit to reduce unearned service revenue and credit to increase service revenue related to the training. And how much would it be? Well, we said monthly it was 4,026. So we could take the 4,026 that we see here and multiply it by 10, or we could say the 4,830.9 multiplied by 10 out of 12. And we get 40,257. This is the next 10 months of training. And this was, again, provided January 1st, and then continuing for 10 months, so through September 30th when that contract was finally completed. Or, sorry, October 30th or 31st. So this would be January 1st through October 31st of 2010 when we're completing that 1 year contract for training. Our last step, step 5, is just a series of facts related to how do we know that we've satisfied our performance obligations. GAAP says, well, it's when the main issue indicator is when control shifts from the seller to the customer. And here are some indicators of a change in control. The company has the right to payment for the asset. This is the seller, of course. The company has transferred the legal title to the customer. The company has transferred physical possession of the asset. The customer has the significant risks and rewards of ownership, and customer has accepted the assets. So this transfer in control usually is indicating that it's time, this performance obligation is satisfied and it's time to recognize the revenue. We recognize revenue from a performance obligation over time by measuring the progress towards completion. We should try to allocate the revenue recognition as the transfer of control is changed from the company to the customer. And sometimes it's used in terms of progress of the cost, the units, or the value added. The last few slides simply provide a summary of the 5 steps of the revenue recognition process. Now, I'm not going to read these. These are included here on the template. There are no words missing here. These are just for your notes. So you may want to, after we've gone through all of the overview of the 5 steps of the revenue recognition process, you might want to just take a few minutes to read through these 5 steps one more time, and we'll work on some more examples in class.